But you've just been hearing from some global experts on what the reaction to the President Obama speech could be on the jobs package. MARC FABER joins in from Thailand to talk about that and other things. Mark, good morning. Thanks very much for joining in. Do you expect a strong relief reaction from global markets, or do you think the markets may shrug off what came through from President Obama's speech this morning?
I think the speech is quite irrelevant. It's more of the same. Again, government interventions, and obviously it's a sign that the budget deficit in the U.S. will not diminish meaningfully, that the government debt will continue to rise. And then we had also the speeches in Jackson Hole and again yesterday of Mr. Bernanke. Again, more of the same. I don't think there will be a strong reaction.
Mark, good morning. Do you think there will be a QE3 though, something that the market has chosen to take away from Ben Bernanke's speech yesterday?
Well, basically the money supply at the present time is growing very rapidly in the United States. There may be some technical reasons involved, and I think that they will not officially announce QE3 with a huge increase in monetization, but I think they'll do it silently.
If that were the case though, if it is any form of liquidity infusion, what kind of impact do you think it may have, A, for the commodities and then for the emerging market space?
Well, basically, I think we have to distinguish in the commodities market between the different sectors, because obviously the price of cotton has very little to do with the price of orange juice and of gold. So I would say, in view of the slowdown in the global economy, I'm not very positive about industrial commodity prices, but I continue to recommend investors to allocate some money to gold.
What are you expecting, Mark, on the 20th of September when the Fed meets for a couple of days? Because the market seems to be building up some expectations from that meeting.
Yes, the market is a discounting mechanism, and as you know, the S&P this year peaked out on May 2nd at 1370, and then we dropped on August 9 to 1102, and then we rebounded to over 1200, so that rebound is or has already discounted some further easing measures by the Fed. But I think that eventually the market will break the August lows and move towards 1,000 or even below 1,000 on the S&P, and that also emerging stock markets, including India, will move lower.
When do you see that happening, Mark? Do you see this rally to 1,200 for the S&P being short-lived and in its last legs? Or do you think it can just amble around for a few more weeks before the breakdown that you're referring to actually comes about through a specific trigger from the Western world like Europe?
Well, we were very oversold in early mid-August, and I think we can rally a bit further. But let's say the strategies, and I don't know the individual portfolios and the position of individuals in the marketplace. If someone has only 20% of his money in equities and the rest in other financial assets and real estate, then he shouldn't worry overly. But if someone is 100% in equities, I would for sure use the strength as an opportunity to lighten up positions.
There's been a lot of analysis, Mark, between comparisons on what markets are doing right now versus the period they lived through in 2008, 2009. How extended do you think this bear market phase or period of underperformance for equities may be this time round?
Well, I mean, basically what has happened since early June is that bonds and gold have rallied and equities have gone down. And so there are some uncorrelated assets, and that's why I'm telling individuals you have to diversify, because we don't know how the world will look like in 5 years' time. I think if someone takes a 5 to 10 years view, to gradually accumulate Indian equities is okay, but I don't think they'll go up by as much as individual investors think. They dream of the Indian market going up by 20% per annum, when in my view, if Indian stocks increase by, say, around 5 to 8% per annum, that will be about it.
Where does the currency fit into this picture, Mark, especially the dollar and the dollar index?
Well, I think the dollar probably is in a marginally better position than the euro, and I would expect the dollar to strengthen against the euro. But I mean, all paper currencies are not particularly desirable and will lose their purchasing power for the simple reason that practically everywhere in the world, including India, we have negative real interest rates. In other words, if as an investor you put your money on deposit, the interest on your deposits, especially after tax, are below essentially the cost of living increases.
You spoke about gold, Mark. Would you buy it here, or would you wait for a reaction to buy into gold?
Well, I've been recommending to buy gold for the last 12 years, and I wrote my book Tomorrow's Gold in 2001, and my strategy is to continuously accumulate gold, and in fact I could make an analysis to show that the price of gold today is probably cheaper than when it was at $300, based on the increase in the government debt, based on the increase in the monetary base in the United States, and based on the expansion of wealth in Asia, particularly if I compare, say, the gold price to the increase in wages in China and India over the last 10, 20 years, then the price of gold is not particularly high.
Thanks, Mark, very much for your views and for joining in today. That's Mark Faber saying he doesn't expect any major reaction from the Western markets to the President Obama.